For our portfolios, UK inflation ticking up to 3.1% was significant. It's the highest in 6 years, and though that might sometimes worry us, we do believe it is transitory, so it's not a concern for us currently. The passing of the US tax reform bill was a big thing in the middle of the quarter. That has now gone through the House and the Senate, but I don't think the results of it are going to be too huge, maybe a little uptick in GDP. One of the biggest things for one of our higher conviction areas, India, was the fact that their sovereign debt got upgraded by Moody's, which is really a result of all their reforms that they've been putting through, which is really positive. We're really positive on earnings in Japan and Europe. They did really well last year, and we think that can continue into 2018. The US, albeit coming into a bit of a late cycle stage, can still really contribute to our portfolios, and we're very positive on certain areas there. Where we're less positive is domestically in the UK, and the withdrawal from the EU is far from certain, and it could cause more harm than good in portfolios. I think like most people, we think a lot of sovereign bond markets are overvalued, and we're concentrating our exposure in high yield and short duration bonds, as we are worried about the exposure to rising interest rates over the next few years. The other area that we are starting to take some exposure is in emerging market debt, still on a short duration basis, but the actual yields that you're getting there are a lot better. Within equities, we are avoiding anything that carries a duration sensitivity. So consumer staples in the UK and in the US are very expensive, so household goods, pet foods, that sort of stuff has been a very popular asset class in the last few years, and the valuations there are probably too high for us currently. Other things we're avoiding are, as I alluded to before, UK assets because of the obvious Brexit risks. In lower risk portfolios, we use property, which is a great diversifier because it doesn't correlate with equity or bonds in general. We use alternatives, which can provide income through things like litigation finance or aircraft leasing, which again don't have a correlation to equities and bonds. And we also like to use other more flexible funds, ones that can use shorting to maybe take out some downside risk and hedge some other risks in portfolios. We're pretty positive. I think equity markets can continue on a positive trajectory that we've seen throughout 2017. Earnings are really, really good in certain areas like Europe and Japan. The US, be it late cycle, can still contribute really decent value in certain places to our portfolios. The UK less so, but it's not something we have to worry about too much. Within bonds, our short duration bias will see us through any rate rise surprises, I think, and the portfolios should be pretty stable.